Bill, what was your reaction to that? And welcome to the show, buddy. What was your reaction to that speech yesterday? And what is the likelihood that this meeting this month is indeed live?
Well, I think it is live because inflation's been above the Fed's target for over 5 years, and core inflation has stayed quite sticky over the last few months. Waller basically is providing the guidance to the market about how the Fed's likely to react if the inflation news is bad that Kevin Warsh has been unwilling to provide. This is one of the problems that Kevin Warsh, I think, has. If he continues to be as silent as he has been about how the Fed is likely to react, his voice is just going to be replaced by other people that are going to provide more insight into terms of how the Fed is likely to react. I think there's a strong case for tightening monetary policy. I don't see much evidence that monetary policy is actually restrictive right now. Financial conditions are extremely accommodative, and that's providing quite a strong impulse to the economy. And then you have the AI investment spending boom, which is likely to continue for a while longer. Both those things, to me, argue for the Fed to raise rates. The Fed isn't there yet. I don't think Kevin Warsh is there yet. If you look at what he said in his public remarks, pretty optimistic about AI, helping you on productivity, holding down inflation. But Waller, has put a marker down. And I think there's a lot of other people in the Fed that feel the same way.
Bill, do you think that's where we can find some common ground? There are some people that do think we are slightly restrictive. Many on the FOMC do not share that view. But can we find consensus around the following idea that we aren't sufficiently restrictive to get inflation back to target? Is that where we can find some consensus on the committee?
I don't think there's much evidence of that. We've been in this supposedly restrictive setting for several years now, and inflation hasn't come down, and the economy and the unemployment rate hasn't gone up. So it seems to me that the evidence that monetary policy is exerting restraint is really quite weak in the current venue.
Bill, we've been just getting bank earnings, and frankly, it seems like all cylinders are firing as quickly as they possibly can, record after record after record in capital markets, as well as Main Street activity that seems to be reaccelerating. By not hiking interest rates, do you think that this Fed is allowing some sort of capital markets bubble, effervescence, whatever you want to call it, to build?
Well, William H. Martin used to say that the Fed's job is to take away the punch bowl when the party just starts getting good. And I would say the party is getting really good right now. So this is, the flip side of financial conditions being very accommodative. And so I think that argues for the Fed raising rates a little bit. The CPI will get a good headline CPI this month, but that's not going to have as much weight now that the war in Iran has started back up and energy prices are headed back up. So it's really what's happening to inflation beyond energy prices that's really going to matter. And I think that's what Waller flagged this past week.
There's a question about the idea of outsourcing some of the commentary to other Fed officials on the part of Kevin Warsh, with Chris Waller really sucking up the oxygen in the room. Do you think that this is actually a desirable outcome, or do you expect Fed Chair Warsh to clip the wings, say, of a Chris Waller?
I don't think that the Fed chair has a lot of power to limit the ability of people to talk about their outlook for monetary policy. I mean, that's what Fed officials do. That's their job, is to conduct monetary policy. So I think the problem that Kevin Warsh might have is that as people like people like Chris Waller speak up, and Warsh does not provide similar kind of guidance about what his monetary policy reaction function is, it basically makes him less important and makes people like Chris Waller more important in terms of guiding markets.
So, Bill, what does he say today? His first testimony as the Fed chair before Congress on the heels of not just what Governor Waller said, but also CPI. Does he just stick to the script of his task force and I'm not going to provide guidance?
I think it's going to be more of the same. I think he's not going to provide much guidance about where he's going forward. I think where he's done himself a good job, done himself a good service, is basically underscoring the fact that he's committed to the independence of the Fed. So compared to where he was when he was testifying before the Senate Banking Committee for his confirmation, he's gotten a lot more distance from President Trump. And I think he's really reinforced the idea that he's not going to change the Fed's commitment to price stability.
Bill, picking up your point about financial conditions, they're easy in some sectors, but do you expect Kevin Warsh to double down that they're restrictive when it comes to the housing market?
Well, I think the housing sector is the weakest part of the economy. But the question is, why is housing weak? Is it weak because interest rates are too high? Or is it weak because we're not having any more immigration into the United States, and so the growth rate of the household formation has collapsed, and so with that, the demand for housing is much weaker than it was in the past. When you're creating 2 million jobs a year, that created a lot of demand for housing. When you're not creating much in the way of job creation, the housing demand is going to be a lot weaker. And so I don't think the housing sector is weak so much because rates are too high. I think it's weak because we're not seeing a lot of growth in the labor force.